Hey everyone! Welcome back to the channel, where we break down complex economic news in simple terms. Today, we're diving into a major topic that could impact all of us: interest rates, tariffs, inflation, and the uncertainty surrounding US economic policy under President Trump. So, let's get into it. The Fed's cautious approach: the Federal Reserve is standing still, for now. But why? Well, there's a lot of uncertainty about how Trump's policies will unfold and how businesses and consumers will react. The Fed is waiting for clear signs before making any big moves. They're looking for two things: one, evidence that inflation is cooling down to their 2% target. Two, warning signs that the economy is slipping into trouble. If either of those things happen, we could see the Fed lowering interest rates again. But for now, they're playing it safe. Tariffs, the big wildcard, one of the biggest unknowns. Tariffs. Trump has threatened tariffs on a much larger scale than expected. Here's what's already in place: tariffs on certain imports from Canada, Mexico, and China. Tariffs on all foreign steel and aluminum entering the US, but wait, there's more. The administration is also working on reciprocal tariffs, set to be announced on April 2nd. These would match the tariffs that other countries charge on US exports, plus extra penalties for taxes and currency manipulation. The fear? These policies, combined with cuts to government spending and stricter immigration rules, could lead to higher inflation and even shake up the economy. Consumer confidence and recession fears. So, how are Americans feeling about all this? According to surveys, not great. People are growing more pessimistic about the economy while also expecting higher inflation. That's a tricky mix. And here's a shocker: for the first time, Trump and his advisors are refusing to rule out a possible recession. That alone has rattled financial markets. If the economy does take a hit, the Fed will be stuck in a tough spot. Its job is to balance inflation and economic growth. But if prices rise and the economy slows, what should they do? Cut rates to help growth or keep them steady to fight inflation? That's the big dilemma. The Fed's balance sheet moves. Now, let's talk about something a bit more technical but super important: the Fed's balance sheet. On Wednesday, the Fed announced it's slowing down the reduction of its massive $6.8 trillion balance sheet. Why? To prevent market disruptions from the ongoing debt ceiling standoff. Basically, the government has a borrowing limit, and if it can't borrow more, it could lead to chaos in financial markets. The Fed will now only let $5 billion in Treasury securities roll off its balance sheet each month, way down from the previous $25 billion cap. Mortgage-backed securities remain unchanged. But not everyone agrees. Fed Governor Christopher Waller actually voted against this decision. So, what does all this mean for you? Well, if tariffs push prices higher, your cost of living could increase. If a recession hits, jobs and investments could take a hit. And if the Fed makes the wrong move, things could get even more complicated. We'll be watching how this plays out, so make sure to subscribe and hit that notification bell so you don't miss any updates. What do you think? Should the Fed lower interest rates now, or is it better to wait? Drop your thoughts in the comments.